Hello everyone, welcome to my channel. This is Easy Accounting channel. Today we are studying IFRS 13, Fair Value Measurements. IFRS 13 increase consistency and comparability in fair value measurements. Related disclosure: true fair value, the hierarchy, categories, the inputs used in valuation techniques into 3 levels. The hierarchy gives the highest priority to quoted prices in active market for identical asset or liability. So we have 3 levels to measure the fair value. Level 1. Inputs are quoted prices in active markets for identical assets or liability that the entity can access at the measuring date. So a quoted market price in an active market provides the most reliable evidence of fair value and is used without adjustment to measure fair value whenever it is available. Level 2. Inputs are other than quoted market price included with level 1 are observed for the asset or liability. So level 2 inputs include the quoted price of the similar assets, the inputs other than the quoted price that are observed for the assets and liability. And then level 3 is unobservable inputs for the assets or liability. So unobservable inputs are used to measure fair value to the extent that reliable observable inputs are not available, thereby allowing for situations in which there is little, if any, market activity for the assets and liability at the measuring date. Measurement of fair value. So the objective of fair value IFRS 13 is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability will take place between market participants at the measuring date under the current market condition. So a fair value measurement requires an entity to determine the following. 1. For a non-financial asset, the valuation premises that is appropriate for the measurement. 2. The principal market for the assets and liability. And 3. The valuation techniques appropriate for the fair value measurement. So let's talk about the valuation techniques. So an entity uses valuation techniques that is appropriate in the circumstances for which sufficient data are available to measure at fair value, maximizing the use of relevant observant inputs and measuring the use of unobservable inputs. So the objective of using valuation techniques is to estimate the price at which an orderly transaction to sell the asset or transfer the liability will take place. So there are 3 valuation techniques that I will talk about. The number 1 is market approach. Number 2, cost approach. Number 3, income approach. So market approach. The market approach uses prices and other relevant information by market transaction, while the cost approach reflects the amount that will be required currently to replace the service capability of an asset. And the income approach, it converts future incomes and expenses to a single current amount. Those are the three valuation techniques for IFRS 13, fair value measurements. Let's talk about disclosure objective. IFRS 13 require an entity to disclose information that helps users of the financial statement assess both of the following. Number one, the assets and liability that are measured on a recurring or non-recurring basis. Number two, for fair value measurements using significant unobservable inputs. Disclosure exemptions. The disclosure required are not required for plant assets measured at fair value in accordance with IAS 19, employee benefits. So retirement benefit plan for which recoverable amount is fair value less cost of disposal in accordance with IAS 36, impairment of assets. Now let's talk about identification of classes of these assets. Where disclosure are required to be provided for each class of asset or liability, an entity determine the appropriate classes on the basis of the nature of the asset, the characteristics, the risk of the asset and liability, and also the level of the fair value within which the fair value measurement is categorized. So determine appropriate classes of assets and liability for which disclosure about fair value measurement should require good judgment. So a class of assets and liability will often require greater disaggregation than the line item presented in the financial statement. Some disclosure are differentiated on whether number one, recurring fair value measurement or non-recurring fair value measurement. So the fair value recurring measurement require or permitted by other IFRS to be recognized in the financial position at the end of each reporting period, while non-recurring fair value are fair value measures that are required or permitted by other IFRS to be measured in the statement of financial position. Then specific disclosure required. So to measure the disclosure objective, the following minimal disclosure are required for each class of assets and liability, including the fair value within the scope of this IFRS and the initial recognition. Thank you for coming to my channel. Please subscribe to my channel and I will see you in my next video. Bye.